Hello and welcome to Business Today Television. I'm Siddharth Zarabi and we are counting down to the presentation of the Union Budget for fiscal 23-24. Finance Minister Nirmala Sitharaman's fourth budget, and a budget which is being described by a lot of people as one that will have to undertake a fine balancing act. To discuss what we can expect and what should be done, although the budget making exercise is done with, is one of the finest economists that I know, Dr. Sajjid Chinoy, Chief India Economist at JP Morgan, who's also a part-time member of the Prime Minister's Economic Advisory Council. Welcome to the show, Sajjid.
Good to be here, Siddharth.
A fine balancing act, would you agree with that terminology to describe the budget in the shortest possible manner?
I think that's exactly the right way to describe it, Siddharth. And I think to understand why it's a fine balancing act, one just has to step back and appreciate how much global uncertainty we start 2023 with, right? That are we going to see the US slip into recession early this year? What does China do to commodity prices, and how much upward pressure will China put? Will the Fed, take rates to 5% or higher, and how long will it keep it there? So there's a lot of global uncertainty, but I think for emerging markets at some level, this is almost a trickier year than the last 2 years, because at least the intellectual consensus was clear about what had to be done in the last 2 years. In the pandemic year, both fiscal and monetary had to provide as much coordinated support as was possible. And over the last year, because so much pandemic support was offered, it was clear that some support had to be withdrawn. This is a trickier year for most emerging markets and even policymakers, because on the one hand, we're looking at a pretty sharp global slowdown. Notwithstanding, the China reopening, global growth is still supposed to go from 3% last year to 2% this year, and the odds are the US will enter into recession at some point. And so you've got to anticipate this global slowdown, which India will not be able to escape. But on the other hand, you still have residual imbalances from the previous year. Core inflation is still sticky. The current account deficit, though the peak has passed, is still quite sticky, around 3% of GDP. So the fiscal has to, in a sense, walk this fine line between preserving and protecting macroeconomic stability on the one hand, and yet trying to generate fresh growth impulses on the other. And I think that's why this has to be a fine balancing act.
Where would those growth impulses come from? Because for a country of the size of India and the needs of its population, growth should obviously be front and center along with a moderate pricing environment. Where will those growth impulses come from, Sajid?
The budgets had a very familiar and consistent rhyme to it in the last 2 years. And I think that it's exactly that consistency that we need this year. What do I mean by that? I think just given where the total size of the consolidated public sector deficits are, we need to still reduce the central government fiscal deficit, especially if you want to avoid any crowding out and you want the private sector to start investing again. So we do need to continue with fiscal consolidation. I would think about 0.5% of GDP or thereabouts is par for the course. And if you notice what the rhythm or rhyme of these budgets in the last 2 years has been, it's been to be quite realistic on fiscal consolidation. It has been to be realistic, almost being too conservative on revenue assumptions and tax buoyancy. And there's been a very clear strategic thrust on pushing public investment and spending on physical infrastructure as a means to both revive the economy from the pandemic and create much needed blue collar jobs. And I think that's exactly the package that we need for one more year. So I would say we need a steady hand on the wheel and to continue to do what the last two budgets did. Reduce the deficit by 0.5% of GDP, be conservative or perhaps not too conservative on tax revenues. And to the extent that space exists, and we can talk about how that space exists, keep pushing on central government public investment as the engine for growth and job creation going forward.
If the government were to consolidate the fiscal deficit to the extent that you are saying, there are various other estimates, but basically between 40 to 70 basis points, would that impact growth going forward? Some of this compression that at least I have been able to understand will perhaps come from lesser spending by various ministries. For example, Jal Shakti. Uh, how will this contraction or consolidation impact growth going forward, or growth will happen regardless?
So that's a good question. How do you consolidate and still preserve spending? So
Hmm.
at some level, the fiscal math this year is a little bit more straightforward. And what do I mean by that? That the bulk of the consolidation has already been achieved. So if you saw in December when the government narrowed the food subsidy program going forward, that along with the fact that the fertilizer subsidy bill next year should be lower, given that global fertilizer prices are lower now, that alone, the combination of lower food and lower fertilizer subsidies should shave off about 0.6% of GDP. So that allows you by itself to reduce the deficit by 0.6% of GDP, right? And because that much of that has already happened, it then opens up more degrees of freedom. What do I mean by that? I mean that on the tax side, this year, because the economy was recovering and inflation was higher, and we've had stronger GST compliance, you've seen that tax buoyancy was above nominal GDP. It was 1.2. Next year, because we know the economy is going to slow, we can be more conservative in taxes and just budget tax buoyancy to be closer to 1. So tax to GDP is the same next year as it's this year. And because the entire consolidation is happening on the back of narrowing subsidies, it also means that non subsidy expenditure, both revenue expenditure and capital expenditure, can be maintained as a share of GDP. So you don't shrink it as a share of GDP. If anything, if your subsidy rationalization is larger, you can even go up a little bit and raise expenditure to GDP a little bit. And I'd expect to see that on the capital expenditure front. So because subsidies have been narrowed and they should, having been on for 3 years, in a way, the fiscal math is a little bit more straightforward. You can be conservative in taxes, you can reduce the deficit, and still maintain expenditure as a share of GDP.
There has been some commentary about, for the last 2 years or thereabouts, the conservatism with regard to revenue projections. When I have asked this question to government officials, they say there was a lot of uncertainty and it was difficult to project. There is also another view which says this is deliberate. But the larger question is, does it sort of impact the sanctity or the readability of the fiscal math of the government? It's been happening for 2 years. I'm not saying it's being done deliberately with a negative intention, but do you think this should be sorted out as well?
Well, part of the reason, Siddharth, has been that we've presented the budget and there have been shocks in 2 of the last 3 years, right? So 2020, the budget came on the 1st of Feb. We had the pandemic after that. Last year, we had the budget before the Russia-Ukraine war. So you've had these exogenous shocks which have upset the fiscal math. Uh, you know, I agree with you that perhaps we don't need to be too conservative on the tax front, but I think the budget's kind of rhythm in the last few years has been let's under promise and over deliver. Now, this year, it may not be a bad thing to be slightly conservative because if you believe that growth is going to slow a little bit, that will affect tax buoyancy.
Correct.
We don't know where commodity prices are going to go because of the China reopening. So it may not be a bad idea to have some conservatism on tax revenues because, as I mentioned, even with that conservatism, you can reduce the deficit and you can still protect expenditure.
In your earlier answer, you sort of gave us your view on how the center can continue to spend on infrastructure and other areas. But this is also the last full budget of the present term of this government. And therefore, the question that everyone is asking, is there space for a populist budget? Quite apart from the political instinct, I'm only asking you from a maths perspective.
Well, a couple of two quick responses. One is why is it important that the center continue with public investment? Two responses to that. Number one, that I think the good news is private sector balance sheets are much cleaner now than they have been in years. We're getting closer to a private investment cycle, but it could still take a little bit of time, just given this unprecedented uncertainty and the fact that utilization rates for manufacturing are still at 75, 76%. So I think the public sector still needs to do some of the heavy lifting before a private capex cycle takes over in 4, 6, or 8 quarters. Now, interestingly or unfortunately, we're seeing that state capex has not picked up in tandem. And if you look at state capital expenditure and capital expenditure by PSUs, the center is not getting the kind of tailwinds or complementarities that you would expect. So the consolidated public investment is relatively flat and being driven by the center. So I think we can't take our foot off that pedal. And I think pushing ahead with physical infrastructure spending, social infrastructure spending to the extent space exists, with large multipliers is the way to go. On your second question on the fiscal math, unfortunately, purely from an arithmetic perspective, there isn't much space here for the reasons we mentioned. That on the one hand, if you want to, reduce the deficit and be realistic on tax revenues and push up public investment, you've eaten up all your degrees of freedom. But also, I think that has not been the pattern of this government to have a large populist budget. So I think we're just looking for more of the same in recent years, which is be conservative, be realistic, and be efficient on the spending front.
Conservative and be efficient on spending. Let's therefore get to hear from you your own expectations with regard to GDP growth in the next fiscal year, assuming that the budget stays broadly in the direction that you have laid out.
I think we need to be realistic about some of the global headwinds that we are facing. Exports have been a huge driver of India's recovery in the last 2 years. To go back to FY21, when India grew at about 8.7%, 3 percentage points of that came from strong export growth. Manufacturing, but also very strong export services, which we can talk about. Now, as that was the year when global growth was at 6%. When the global economy slowed to 3% last year, the contribution of exports already fell from 3% to about 1.8 percentage points as per the government's own advance estimate. So my sense is next year, if the global economy does slow further to 2% or below, we have to be realistic that exports may well turn from being a tailwind to a headwind. The silver lining in all of this is even as goods exports face big headwinds, services exports have been doing very well in India in the last 6 to 9 months, and hopefully that can continue. But broadly, the contribution from exports is going to be lower. We have to accept the fact that policy is being normalized around the world, and that's important for macro stability. So real interest rates have gone from negative territory to positive territory, as was needed to keep inflation under control, and fiscal deficits are being consolidated. So some kind of slowing is inevitable. We shouldn't panic. This is happening the world over. I think of this as the slowing needed to bring down imbalances, to bring the current account deficit down, to bring core inflation down. And if we can get through this year, even if the economy slows, that's okay, because over the next 3 years, the fact that balance sheets are much cleaner, suggests that we're getting closer to an investment cycle. So we just need to be patient and accept the fact that growth, will be slower in 2023 around the world and therefore in India.
That's a very good way that you explained it. And if I were to just add, the vehicle that's running on this road has to slow down because the road ahead itself is bumpy, and that's something that we have to be cognizant of.
We have to avoid accidents this year. Growth will take care of itself once we get through this rough patch globally.
That's a very good point. Now, the question that our viewers would like to understand is, what's your own reading of the global economy? If you could sort of expand on what you just said in the previous answer, especially from the linkages that India has from an export point of view. What's going to happen globally this year, according to you?
Yeah. So, there were, when we ended last year, there were a few outcomes here. One outcome was that, will we slip into a deep recession early in 2023? A second possibility was growth will hold up, but inflation will not come down, and that sets us up for a hard landing in 2024. And the third outcome was more of a Goldilocks outcome where growth slows a little bit. There's not a deep recession, but slows enough to bring inflation down, to cool labor markets, and you get some kind of a soft landing. That's where global markets were. Those were the possibilities that were being explored. Now, the data flow in the last 2 months has actually been quite constructive. We've seen that China has opened faster than people thought. We've seen that Europe has had a shallower contraction than people had feared. And we're seeing that at least there are tentative, early, tantalizing signs that not just headline, but core inflation is coming down around the world. So there's a little bit of hope now that perhaps we're heading towards a soft landing scenario. I think we need to not be complacent. There's still a lot of uncertainty. Core inflation has come down, but not to the levels that central banks will be comfortable with. The labor market in the US is still too hot, and the US economy is slowing much faster than had been believed. So there are any number of risks left. But in the aggregate, the expectation is expect a sharp slowdown in 23, but maybe we can avoid a deep recession and we can avoid a hard landing. That said, there's a lot of uncertainty. One thing, Siddharth, we speak a lot about India's goods exports. The one silver lining in all of this has been the extent to which service exports have picked up in the
Absolutely.
last 12 months. We used to be tracking $18 billion a month in terms of IT and ITES and BPO service exports. That number rose to 21 billion last year. It's running at 26 billion this year. So huge tailwind to the balance of payments and the promise that increased digitalization and work from home will benefit India, right, is being realized. So I think that's really important. But we can't get complacent. For me, the key for the next 3 years is jobs, jobs, jobs. We're seeing service sector, white collar jobs. We need to double down and focus on manufacturing, blue collar jobs. That's where I think the focus needs to be.
Okay, I'll take this jobs bit subsequently, because I want you to explain to our viewers what is happening to inflation in the United States. Once headlines about US inflation being at multi-decade highs came out, everyone sort of paid attention to it. And the US government has taken some unprecedented measures, and they always respond to crises with a big pot of money that they throw at crises, including the Inflation Control Act. How will US inflation pan out? Because in some ways that will ultimately end up impacting, among other things, our markets, our stock markets as well.
Absolutely. So, we've seen inflation highs, 50-year inflation highs in the US. I think headline inflation is coming off from a momentum perspective quite sharply because the push from food and fuel prices is reversing. So even though food and fuel prices may be the same in level terms, inflation is a change. That change has dissipated. So you may find that headline inflation in the US comes off faster than people expect. But the key is going to be core inflation because that's what the Federal Reserve looks like. What's true underlying inflation? Now, there again, the last 3 months, tentative signs that core inflation is rolling off. The big uncertainty for me is the labor market because the US labor market is so tight at the moment that bargaining power perhaps still lies with workers and wage inflation is still running between 4 and 5%, depending on how you look at it. So the question is, can you get 2% core inflation, which is what the Fed's target is, if wage inflation is running at 4 to 5%, especially in a year where productivity growth is slow? And that's the big unknown that the Fed is facing, that will they have to slow the labor market down much more? Will unemployment have to rise further to bring core inflation? Now, if the answer is yes, then you're looking at a US recession. If the answer is no, that you can get modest increase in unemployment and wages will fall, then you may not risk a large recession. But that's where the debate currently is. That the US labor market's very tight, both because demand was strong, and there was a huge supply shock on the labor front because of the pandemic. And how much does the Fed have to slow the labor market to bring wages down and therefore core inflation?
What about inflation in India? What's your own reading of how it's going to pan out?
Encouraging signs that headline inflation is coming off faster than markets had thought. We're below 6%, and I think we've gotten some tailwinds with food prices. But again, food tends to be very volatile. It comes down 3 months, goes up the next 3 months. So the RBI is currently also focusing on core inflation. And core inflation in India has been very sticky. It's been close to 6% for almost 3 years. So I think the central bank is correctly saying that, it's too early to claim victory, we need to see core inflation coming off. I think the RBI has done a masterful job about normalizing monetary policy from very accommodative levels over the nine months and normalizing both liquidity and rates in a non-disruptive manner. But I think markets still expect that we're not quite done with the rate hike cycle, that you perhaps need one more rate hike, and you need for the previous rate hikes to transmit, because only when there is conviction that core inflation is rolling off and inflation expectations are softening can the central bank breathe more easily.
One quick follow up on this. How significant is the artificial sort of cap on petroleum diesel prices, the daily changes which have stopped for many months now, from an inflation perspective? Because you know that that is a big burden that the government and the oil marketing companies have taken on themselves. If it had been passed through, how would it have impacted the readings?
Yeah, no. So again, it cuts both ways, because at some point, when the taxes were put on, the disinflation didn't pass through. And now with the taxes remaining, the inflation may not pass through. So why it would have had some impact at the margin, I don't think that's the real story. I think it's the breadth of core inflation and the stickiness around 6% that will be a key focus of policymakers. That yes, fuel is one part of it, but with inflation expectations broadening, it'll be important to bring core inflation down to more manageable levels. I mean, I'm going to avoid technicalities, but when headline and core diverge, at least the work we've done finds it's headline that ultimately converges to core and not the other way around. So core inflation today is a very good predictor of where headline inflation will be 12 or 18 months from now, which is why I think the RBI is correctly ensuring that their focus needs to be on bringing core down.
For the average viewer, Sajjid, what is the reason for core inflation remaining so sticky, like you said, for an extended period of time?
What we've seen is sharp input cost pressures, right, over the last year. That you saw that first you had a lot of supply shocks. So first it was manufacturing supply chains because of the pandemic. Then we had a large fuel and commodity price shock after the Russia-Ukraine war. And when you get such large input cost pressures, firms tend to pass those on, especially when the economy is recovering and demand tends to be inelastic for a few months or a few quarters. So we've seen firms pass those on. Now, these things tend to be very asymmetric. When prices go down, firms tend to hold on to those margins and not cut output prices. So I think that's perhaps one explanation. The other explanation is when you're living with high inflation, like the world has for many years, inflation expectations tend to harden. We've seen that around the world. We've seen that in India, both businesses and households. And when inflation expectations harden, there's a self-fulfilling nature to the inflation process, which is why I think it's important to be kind of very laser focused on core, on inflation expectations, and make sure that monetary policy is appropriately calibrated, that these things don't fester, they begin to soften, and then the RBI can take a breath.
Sajjid, I want to come back to that previous point you made as we wind down this conversation, and this was the focus on jobs. Obviously, jobs and their need manifests in many ways. It's a balance sheet driven exercise, the budget, but at some point there is societal and broader economic repercussions also. What can the budget do for job creation?
So a couple of things. I think, firstly, it's not easy to create jobs. We're seeing around the world that in times of such seismic change where you have, so much technological innovation, there are sunrise industries, there are sunset industries, and reallocating labor is challenging in the best of times. You're seeing this in all labor markets. What can the budget do? I think the budget has correctly decided 3-4 years ago that while the private sector takes time to recover, that so for me, the key to job creation is investment. So, the way things work is when you get an investment cycle, then you create jobs. When there's income certainty and job certainty, people tend to spend and consumption picks up. And when consumption picks up, it kind of ratifies the need to invest. That's the virtuous cycle you want. Now, the private sector, for all the reasons we've discussed, has been slow in investing over the last few years. Hopefully, we're getting closer, but it could still take some time, which is where the public sector has to fill in the gap. So I think what the budget can directly do is continue with allocation for physical infrastructure, social infrastructure, and execute that. I mean, to the government's credit, in a very difficult fiscal year, they're meeting their public investment targets. And I think the government needs to ensure that states and PSUs also come on board. So you get a bigger, broader public investment push. What that does is it creates blue collar jobs, the kind of construction jobs that you need after some of the impact on the pandemic. And remember, public investment has large multiplier effects because once the public sector starts investing, at least in some areas, you find that utilization rates go up, and then that crowds in the private sector. So I think the direct channel is going to be this big push on infrastructure that needs to continue, in my mind, for another year or two. And the indirect channel is just certainty that, when there is macroeconomic, regulatory certainty, when inflation comes off, when the current account comes off and there's less macro uncertainty, then you foster the climate for the private sectors to start investing. So I think there's a direct channel and an indirect channel.
You made a very valid point about the states lagging when it comes to certain kinds of capex and infrastructure, including, for example, the bullet train. It's running delayed, and that's just one example, viewers. But as I ask you the final question, Sajjid, the point really is, you said what can be done. I would want you to tell our viewers, what do you think that should not be done at all in this budget?
Well, I think it's standard of any budget, just no unpleasant surprises at this point in time. I think we've gone through so much uncertainty, so many global shocks the last 3 years, that you want a steady hand on the wheel, steady as she goes, no unpleasant shocks, consistency. And I think maintaining a similar pattern to the last two budgets would I think, exactly what the doctor ordered here, given where we are in this macro setup.
Absolutely, and we'll have to wait for what the good doctor, the finance minister and Prime Minister Narendra Modi have prescribed for the Indian economy. Remember, this is the last full budget, 9 state elections, viewers, and then the big one next year, and before that just an interim budget. So a lot of expectations, but like Dr. Sajjid Chinoy made it clear, a balancing act with hopefully no negative surprises and unpleasant experiments. Dr. Chinoy, thank you very much for your time with us today and taking out the time to explain what this budget could bring for us. With that, it's a wrap on this conversation. If you've been, thank you very much for watching.
If you like the video, do like, comment, share and subscribe.